Good afternoon, everybody. Jay Permisco here. Welcome to the webinar with MBS Live and the one and only Matt Graham, who is CEO and founder of MBS Live. And oh, by the way, I have no affiliation. I don't have any shares of MBS Live, but I was lucky enough to get an MBS Live t-shirt. Actually, I got two of them because I knew I was going to ruin one of them. And we don't have a gear store or anything else, but a little background, if you haven't worked with Matthew Graham, he runs mbslive.net, which is a really huge influential tool in the industry. And Matt and his team provide a tremendous amount of background and information on how mortgage-backed securities work, what the markets are doing, lender tabs. It's a huge collaboration tool that I've been using almost 20 years now to get some insight into the market. And we have a lot going on. The timing on this couldn't be any better. Matt's going to provide an overview today on what we think is going to happen and why. And we'll probably be, if we've got 500 on our answers here today, we'll be doing good. You can use the chat. We want this to be really interactive. You probably have a lot of questions, a lot of concerns. There'll be things we can answer, probably stuff we can't answer, and there'll be a whole bunch of stuff we'll say, I don't know. You can use the webinar chat for the MBS Live community. I have the chat open now, so if you have questions there, by the way, we love the MBS Live community. So if you're on, we just really appreciate you so much. So I'll turn it over to you, Matt, with your analysis. What the heck is going on and why?
All right, thanks, Jay. And yeah, good job on the t-shirt. You will need to order another one. I think your workout routine is going to probably ruin that one. So get the next size up to accommodate those the gun show. So I put some slides together, and as always, it'll take me just a second to do the screen share and get that set up, and we'll get going with that. Okay, slideshow. Here we go. All right. Am I visible there?
You are visible, Matt.
Okay. So, and naturally, I'm gonna have to minimize zoom. Okay, now I can see everything. So last time we talked about inflation being the big market mover and the big thing to watch. And so much has changed just in a few short months because of these three inflation reports that show up in the green bars in this chart. So this chart has core month-over-month CPI, and that's the consumer price index, one of the two main inflation indices, and the one that was responsible for the lion's share of market volatility many times over the past few years, even unseating the mighty jobs report as the biggest monthly market mover in terms of economic data. But then we had these three reports that sort of did a lot to push back against the early 2024 inflation data. And in fact, if you were to annualize those three reports, we're well under the Fed's 2% annual inflation target. There were other good things that happened there. So much so that when we got to today's CPI report, it really had permission to do what it did here, which was to come in higher than expected without upsetting the market too much. And you can see that in today's bond market activity where we haven't really lost any ground. If there was one reason to be concerned about inflation, it would be the shelter component. So this is the same data series, but this just focuses in on the shelter component, which is the way that CPI measures housing. And it does so by trying to avoid housing's investment component because housing can appreciate. It has investment gains over time. And shelter strips that out by focusing on rent and owner's equivalent rent, which is controversial to some, but tends to do a good job over time matching what actual rents are. And that June report was really, really exciting for people that have been watching inflation and probably for the Fed too, because it showed shelter dropping to the lowest levels since late 2021. And that meant that we had likely turned a corner because historically when shelter makes a big shift like that, it sticks. And now the past 2 months, as fleshed out with today's data, have shown that it is not sticking, at least not yet. And that's a little bit of a cause for concern. It raises some serious questions about whether inflation is really something that we can push to the sidelines, or whether we need to sort of keep an eye on it and re-verify that it's doing what it needs to do for rate cuts. So the focus has shifted squarely to the labor market. We've heard the Fed say this increasingly recently. And just before the blackout period began last week, we had the two Fed speakers last week saying it's definitely time to shift focus to the jobs market. And in that regard, that's good for rates too, because since April, NFP has been much cooler. It hasn't been below the historical range, but it's been on the lower boundary of that. And at the very least, you could look at non-farm payrolls here and say this is not a labor market that requires the Fed to be in a super restrictive stance in terms of rates. And that's what the Fed is thinking and saying too. And that's why the Fed has clearly communicated that they're cutting rates next week. They haven't clearly communicated how much they're cutting rates. And that's been a topic of great debate in the financial market. But we know they're looking more at labor market data and specifically the jobs report. But there are some other places they can look as well. Unemployment rate's part of the jobs report. And this is definitely something that everybody is considering. It's definitely something everybody was talking about when the SAHM rule came up, SAHM, referring to Claudia Sahm, an economist who made this rule about the unemployment rate rising 0.5% in a certain period of time always indicates a recession type of thing. And this chart sort of says the same thing in not so many words. Anytime that we've had unemployment rate tick up by as much as it has this time, it has always given way to a much more rapid spike and a recession. Could this time be different? That's the main question, right? The post-COVID economy created so many new scenarios and maybe rewrote some of the norms for what the labor market should do and how it should do it, that we can wonder if we're still experiencing some range-finding volatility in the unemployment rate. I don't have a strong opinion on that, but if there was ever a time to question the relevance of past precedent in terms of indicators in the data, this would be it. But at the very least, you see a bounce like this in unemployment and you start to get a little bit worried about the labor market. Jobs and inflation have given mixed signals. So we had the weak jobs report, but as we'll see in the next slide, it wasn't weak enough for traders to conclude that it meant that the Fed would cut 50 bips next week. We'll talk more about that in a second, I promise. And of course, today's inflation data didn't do the same thing. But let's take a look at what the total of these two reports did to the December and the June outlook and the longer term outlook. And by the way, I should mention, this chart shows the implied yields from Fed funds futures. That's the market's way to bet on the level of the Fed funds rate at various points in the future. The blue line corresponds to where the market thinks that the effective rate's going to end up for September, and red line December 2024, and then the purple is June 2025. So it's hard to see in this chart, but the September 2024 rate actually went higher since the jobs report, and the June 2025 rate went lower, and it also wasn't really bothered by today's CPI for that matter. Here's what just the September Fed funds future contract looks like. And this goes back to last Thursday. And so we can see last Friday's jobs report here. And the green highlighted part of the line, that's the initial reaction to the jobs report. So when NFP came out weaker, markets rushed to price in a 50 bip Fed rate cut initially. Then they sort of thought better of that. And then Fed's Waller, I guess, I don't know if he was giving a speech or if he was answering questions at that point, but there were several news wires from Waller that came out. And the initial reaction to them was that he was saying the Fed is definitely going to consider cutting 50 bips next week. Then Wall Street Journal's Nick Timmerhouse said that, hey guys, why don't we read this in detail and look at the word if and consider that Waller is actually saying that the Fed could cut faster if they needed to. He's not saying they're at a point where they need to, but if they need to. And just with that tweet, and I promise you it was that tweet because I was watching it come in, I was watching futures volumes. It completely catapulted Fed funds futures back toward that 25 bip rate cut. And now with this morning's CPI, you pretty much have cemented the case for a 25 bip rate cut. But again, this is just the way September's playing out. And as we've been talking about on MBS Live, it's not really so much about 25 versus 50 in September. And whatever the Fed does next week, if let's say they do 25, which is definitely more likely, then they can convey the willingness to do more for rates, either via the dot plot, which is the summary of economic projections in which each Fed member gives their outlook for where the Fed funds rate should be at various points in the future. They can also sprinkle in some verbiage into the announcement itself. That's a little bit dovish. And of course, Fed Chair Powell has the press conference half an hour after all that other stuff that he can use to convey rate friendliness. And I think it was always the case that if the Fed cut 25 bips, they would probably try to convey a little more rate friendliness elsewhere in the Fed Day festivities. And if they happen to cut 50 bips, then they would probably try to dial things back. And just to be clear, it's not necessarily clear what's better for us in the short term, if it was 25 or 50. And, we spent a lot of time pushing back on clients' expectations about the Fed funds rate filtering through to mortgage rates. And there are different ways you could take a 50 bip rate cut. You could say that communicates some concern about the economy. You could also say that leaves less room to cut rates additionally in the future. But if I were the Fed chair, I could definitely make a case for 50 if I wanted to, and I could make a case for 25. So they'll do that next week, and I think we'll get a better sense of the lay of the land at that point. Either way, it was so interesting. Traders were definitely determined to pick a winner, and we could see that they were just really waiting to solidify their bets until they had every last piece of information on Friday, and Fed's Waller happened to be the last person to speak. Don't sleep on jobless claims tomorrow. So we have had CPI this week. CPI has been a huge report in the past. I would probably say jobless claims is more important than CPI right now, if jobless claims does something other than continue to fall in line with past precedent. And it sort of did that 6 weeks ago, and that really helped the big rally shape up on the NFP week. But then it fell back into line, and that's when rates moved back up. So now it is right in line with 2023's unadjusted levels. If this red line were to sneak up out of the range of these past 3 relevant years, and I say 3 relevant years because we throw away 2021 and 2020 because they were completely off this chart. If the red line were to sneak up past those previous years, then there would be additional evidence for the labor market softening. And whether or not that would be enough for the Fed to actually heavily consider a 50 bip cut next week would remain to be seen. But the market would certainly start to be pricing that into Fed contracts that are farther out into the future. So can anything hurt us now, right? Is there a reason that we shouldn't be, I don't know, expecting rates to be in a friendly trend because we've turned some big corner in ideological sense? And I'll just offer you some perspective on that. Maybe you call it devil's advocate perspective. And first things first, we're still in an uptrend historically in the big picture, going back to 2020. Rates are still rising in a broad sense. And we're actually not recovered too much more in that trend than we were a few times in the past before rates continued to move higher. We also want to consider momentum technicals are overbought right now, which is not a surprise to anybody that knows even a little bit about momentum indicators. Anytime you have a big rally, you're going to have overbought technicals, but it is still something to consider. These lines at the bottom of the chart are stochastics, and when they are at the lower end of their range, especially when they break out of the lower end of their range, it signals sort of a readiness to respond to any negative impetus. It doesn't mean that rates are going to spike imminently, but it does mean that they're going to be more willing to spike if they find justification to do so, I guess you could say. And the only other time that we were this overbought was at the beginning of 2024, and that's when rates moved, about a little over 0.5% higher in terms of 10-year yields, and definitely in terms of mortgage rates. So just something to be sensitive about when it comes to that. We could also consider some pretty scary past precedent. And this is core CPI in year-over-year terms, showing how in the past, when we've had hyperinflation, there have been some false starts. We've had inflation look like it was going to correct, only to resurge and then to do it again 2 more times before ultimately calming down. And interestingly enough, the current spike and calming down moment for inflation looks exactly like it did in the late 60s, right before the hyperinflation episode of the 70s started. Not trying to scare you here. We're going to get somewhere fun with this in a second, I promise. How about treasury issuance? We talk about the fact that the more bonds the government issues, the more upward pressure there is on rates. So here's the market value of treasury debt, just basically showing a relative level of issuance over time. It pretty much only goes one way. And we can also consider the Fed is tapering, or not tapering, but they're in their quantitative tightening period where they are letting bonds roll off their balance sheet quite successfully, I might add. It hasn't been successful as far as originator pipelines for the most part, but as far as the Fed's concerned, they've been able to shrink their balance sheet quite a bit so far. And that means there's just less and less demand on the Fed side of the equation. It also means the way they're doing it is there's less specific demand for mortgages, because as mortgages roll off, they're not any roll off that meets the criteria to be reinvested is being reinvested into treasuries and not into MBS. So to sum up those preceding scary slides, just FYI, that's all horseshit. This is my attempt to say that somebody can put slides and charts in front of you to convince you of something. It doesn't necessarily mean it's going to happen. You can always come up with a way to look at seemingly objective economic data, seemingly objective charts, and just remember, predictions are for suckers. Nobody knows where things are going. Nobody knows whether or not we have covered too much ground toward lower rates yet. On one hand, I could tell you, look, the Fed's been so restrictive that given where NFP is and given where all the other data is, they're still way too restrictive, up and over 5%. They can bring the Fed funds rate down almost 2% and still arguably be in territory that's still restrictive. And then I could also do stuff like I just did before the horseshit slide and tell you, hey, look, there are reasons that you don't want to get overconfident here, and rates could actually go back up. And there are smart people that say both of those sides of the coin out there every day and really grind an axe on that. And so, from my view, it's just important to keep in mind that we don't really know. We don't really know who's right. We don't know how things are going to pan out. We don't know how the data is going to pan out, and we don't know what type of unforeseen shock is going to happen. So it's important to keep an open mind and stay tuned in, and just be realistic about what you see happening and how it's impacting the market. That's all for now.
Yeah, the CPI number, if you listen to some analysts this morning, depending on what side of the fence you were in, there was good news or bad news, depending on which way you looked at it. Like the CPI number, if you look X food and energy, it's like the 51 months in a row of month-over-month growth in that component of the CPI number. Like, okay, that sounds bad. And then, well, let's look at if you peeled off probably the most important part that drove that number up. It's really shelter and insurance. That was the problem. And oh, by the way, shelter, does anybody think that their rents are high? Yes. I mean, it's just like Captain Obvious numbers inside that CPI number. And so what I was, I guess, most thankful for, it was kind of a neutral based number, and the market didn't overreact in any shape. I mean, yes, plus or minus a couple ticks. And somebody that runs a mortgage company or capital markets desk, what they would rather see is this than some kind of wild gyration, which goes up and down every single day. And if you're a loan originator, it gives you some confidence too, because it's not, oh yeah, I locked yesterday, should I have locked today? Yeah, you probably wind up right in the same place. And so tomorrow will be a big day. Clearly, we have some things to talk about for next week. But overall, is this economy good or bad? I think that there's 2 things in regards to that. Everybody talks about Jerome Powell, so really, really, really hard job. He is trying really, really hard not to repeat Arthur Burns' mistake in the 70s. That is you brought it up. You can overreact here and end up way on the other side of the spectrum. Could you not, Matt?
Yeah, totally. Um, and and it's tricky because how much weight do you give to past precedent in the 70s? How much does that stuff apply to the modern economy? Powell doesn't rightfully know. Nobody really does. All he knows is that you want to, just like Bernanke knew, you wanted to lick deflation before it got out of hand. Powell knows you want to lick inflation before it gets more out of hand than it already is. And he figures, hey, look, we can keep an eye on this stuff, right? If jobs are doing okay and stocks are doing okay, they don't always say the stock part, but they think it. If that stuff's doing okay, we can afford to be restrictive. And they've said this explicitly, and I don't know if people have really picked up on that. Um, Time and again, that's been their mantra. We can afford to be patient due to the economic data. And now that the economic data is shifting in pretty clear way, they're no longer patient. They're going to do something, and they'll do more and more if it looks like it's going to be bumpy. But yeah, they really didn't want to jump the gun, and Powell was certainly determined to avoid repeating the mistakes of the past. He said that time and again. He used specific verbiage to reference Paul Volcker's book, Keeping at It, and putting that in his speeches several times. It was not a secret to anybody.
Yeah. Yeah, and again, what has driven most of this has been debt, right? And that chart where you showed government spending, and the only way to afford that is to do what? Issue more debt, and then
Yeah.
how much of this debt can we still sell and have people buy? It brings back a question. So, if you're an originator today, broker, company owner, what are the if I'm thinking about the future, what are the kind of the two main components I'd look at? Because we could look at 5,000 data points, Matt. What are the two data points I should look at on a daily basis to kind of give me a sense on where are we at?
On a daily basis, that could be a little bit of a different answer, but as the data becomes available, would be still inflation, still important, and it is just sort of given up the spotlight to labor market data. You can take your pick on the reports you want to follow, but certainly the market is going to put the most weight on the big jobs report, non-farm payrolls, aka the employment situation that comes out on the first Friday of any given month.
Yeah, I guess that was a loaded question because I was trying to get you to commit on the daily component. Because if you really want to drive yourself nuts, look at data every day and try to
Right.
make a decision on what you're going to do the following day. And it'll really absolutely drive you nuts. Which leads me to my next question. So, from what you see from a trading perspective, you have access to data that even likely I don't have. But how's liquidity been in the MBS space lately?
Well, it's negatively affected by volume because there's much less volume than there had been when there was a robust refi market, and things are very, very clustered around the coupons that correspond with rates right now, and especially new purchase origination rates. So everybody sort of is like a second grader in a soccer club following the ball, right? Everybody's supposed to be playing a position, but really everybody's just following the ball, and that metaphorical ball tends to hover around 2, maybe 3 mortgage-backed securities coupons, and that tends to be where the lion's share of liquidity is. And even then, on any given day, there are certain times of day where liquidity is poor, especially early in the morning and late in the afternoon, and it's only really ever decent when it comes to the coupons that are in fashion. So that can have a big negative impact on volatility.
Yeah. And speaking of second grade math and second grade, can you just explain? Because I get asked a lot of questions on, because we talk, the people that have been in the chat a long time, we talk about spreads and we talk about coupons. Can you explain to a newbie what a spread means between the two?
Yeah. Do you want some slides? Did I ever do my spread slides for you?
Do a spread slide, man.
I got some spread slides. Hold on. And yeah, they're pretty good. They're pretty informative. If you're a big fan of this spread thing, you're not going to really like it, but it does end with good news. So, okay. Hey, look, I had these slides ready to go. So can mortgage rates drop even if treasuries hold steady simply due to a contraction of the spread? So this was a popular concept because spreads blew out so wide, and you could point back to when they were more historically narrow. By the way, the spread is the difference between, well, there are a couple different spreads, but the one people were talking about was the difference between 30-year fixed mortgage rates and 10-year treasury yields. That has a historically relatively stable relationship relative to general bond market volatility. And if it was simply in a more normal relationship, then mortgage rates would be 1.5% lower at any given point. And so people were wondering, why can't we make the spread tighter so that we can have lower mortgage rates without the Fed even needing to cut and without treasury yields needing to go lower? Why can't the spread be lower so we can have some more business and eat something other than top ramen as originators? And so it was a valid question. It was an emotionally charged question, but one that ultimately didn't make a ton of sense. So here's a quick background and history lesson, and we'll just look at the movement versus treasuries. So there was a lot of normal relationship, the blue line being mortgage rates on one axis and the orange line being the 10-year yield. A lot of normal correlation. In fact, some people are surprised just how correlated things are. And this is the reason that a lot of originators back when I first started this said, no, I don't need MBS. I can just watch the 10-year. And you could. So many times you could. But not in early 2020 when mortgage rates spiked quickly while 10-year yields continued to drop. And that occurred for a variety of reasons. One was liquidity, and the other was operational constraints. Mortgage lenders just couldn't keep up with the demand that was generated by the super low rates. And then the mortgage-backed securities market couldn't price them efficiently. Meanwhile, the treasuries market is so deep in terms of liquidity that it can go wherever the demand for interest rates wants to go. So mortgage rates blew out and treasuries hit bottom immediately and then went sideways. And then during the process of treasuries going sideways, mortgages eventually started to correct, but this was the period of widening marked by the W, wider spreads. Okay, then there was tightening. So treasuries actually started to move back up in yield while mortgage rates were still coming down as lenders were getting caught up with capacity constraints and as the secondary market was getting more efficient in pricing the mortgage-backed securities needed in order to offer lower rates. So that was what we would call spread tightening. You don't refer to spread in terms of higher and lower, you refer to it in terms of wider and tighter. So you had a widening moment and a tightening moment. W and T can mean other things too in popular abbreviations, and that's when you come across 2023 and early 2024. And I'll leave it to your imagination as to what the F means in that situation. But then you had the rampant volatility into the rate hike cycle, and you had mortgages blowing out. You had investors not really wanting to hold a mortgage when there was a risk that it was going to be paid off in the event that rates were able to recover. And if investors don't want to hold that mortgage, it makes prices go down because they're not offering, a good premium to buy loans. And when prices go down, MBS rates go up. And meanwhile, treasuries are able just to continue to operate in the liquid world, and MBS are not, and spreads blow out. So that's what created the spread drama that we've seen. And this is when people started to talk about, hey, why can't we get some love here? So this chart is just a representation of this chart of the last one, subtracting the orange line from the blue line. So this is 10-year treasury yields subtracted from mortgage rates. This is the spread. And so that big F moment is when the spread hit the highest levels since the great financial crisis, a little bit higher at times. So yes, it was very wide and it's only natural to hope for tightening, but is it smart? So let's talk about what a normal spread looks like. People are saying, why can't spreads just go back to normal, right? Because just a few years ago, we were at spreads of, 1.5%, give or take. Really, really, really important to remember that occurred during quantitative easing when the Fed was actively buying MBS. Okay. The previous spikes are understandable. We had the great financial crisis and we had COVID, and then we had the rampant tightening cycle and hyperinflation. But what happened before that? Before that, we had what I would consider to be the old normal back in the 90s. And that was before the Community and Reinvestment Act. As soon as the Community Reinvestment Act was made into law, spreads widened immediately because it widened the credit box for Fannie and Freddie, and it made investors less eager to pay a premium for mortgage debt because it was viewed as less certain. And keep in mind, when we talk about investors' willingness to buy mortgages, it doesn't have to do with them getting their money back, because them getting their money back is guaranteed by the government, either directly or indirectly, depending on what kind of MBS they're buying. They're not worried about getting repaid. Fannie and Freddie will take care of that. There might have been a few months where that was in question before the conservatorship, but that definitely put a fairly explicit government guarantee on mortgages. Investors are worried about getting paid back in a time frame that they're not expecting due to rate volatility or other things. So the Community Reinvestment Act, if that is expanding the credit box to people that might not be able to pay their mortgages as well as people had been in the 90s, now investors had to worry about mortgages getting paid off sooner because people were defaulting or having to short sale or just having to sell their home sooner than they otherwise would have. And when somebody sells their home, then that MBS is retired, and or not that MBS, but the mortgage inside that MBS, and that negatively affects the investor return if they were planning on collecting interest over time. So Community Reinvestment Act really made what I would call probably the best baseline time frame for what normal spreads are. And that's something around 2% versus 10-year treasury yields. And so, we're at 2.4 right now. We're pretty much back there. So this was always going to come down, this old chart, by the way. This was always going to come back down, but it wasn't necessarily always going to come back down to the 1.5 range. It was always going to come down to that early 2000s range, and it's pretty much done that. The last thing to consider when it comes to spread is whoa, hold on. I just ruined the surprise. Damn. JP, let me ask you, if you had to pick a treasury yield, a treasury coupon that most closely matched the average lifespan that investors are expecting for mortgage-backed securities, would you pick the 10-year treasury right now, or would you pick something else?
Based on what I think is going to happen, I would rather choose a shorter duration security.
Yes.
And there's a whole bunch of methodology around that, but probably a 2 or 5, probably the 5. But
yeah, and you said 2 or the 5, which means that it's either the 5 or it's even shorter than that. I'm not going to go any shorter than that in the next chart and just say, here's what happens when we chart mortgage rates versus a 5-year treasury. Now all of a sudden we're right in the middle of the historical range, and spreads are not blown out when you consider what the market is expecting for the duration of a mortgage-backed security. And duration is everything. The amount of time that an investor is tying up their money is critical in determining where they're going to invest. So if their alternative is a 5-year treasury, now a mortgage is, it's not as much of a blowout versus a 5-year treasury as it is versus a 10-year treasury. So all that to say, spreads are not as blown out as they seem. They were always going to come down. They've already been coming down, or tightening, I should say, since I'm the one that said don't say up or down in terms of spreads. And they can continue to tighten. But I'll ask you this: let's say that the spread versus 10-year treasury yields just got stuck at 2% and it never went any lower than that. Would an originator care about that if the 10-year treasury yield went to 2% and you had 4% mortgage rates?
No.
Nobody would care. So incidentally, the lower treasuries go, the less an investor has to be worried that mortgage rates are going to drop so fast that they're going to get paid off early, and spreads will tighten a little bit more. And the more stably that rates can hold near a lower range, the more spreads will tighten. The investors don't like volatility, and they don't like super high rates when it comes to trying to keep a tight spread between mortgages and treasuries. But that's the spread thing people have been talking about, and it's not something that anybody needs to talk about or really worry about. It's something that will all come out in the wash of its own accord.
Yeah, it's funny. I mentioned two because everybody that issued any type of mortgages a couple of years ago probably should have been following the two because the duration on those, given what I think is going to happen, people, companies that paid up for high coupon stuff a couple of years ago. Yeah, well,
Yeah.
we've got we've got some refinance activity already happening. In the government space, we've got rates firmly in the fives, conventional stuff firmly in the low sixes. And we're posting it was, I almost, started crying because our capital markets team's like, hey, let's post 4.25 on government rates on a rate sheet. And I go, what does that even look like? And it's actually within range. I mean, it's possible for us to get there, which is exciting. But as you can imagine, pricing, people that are in the business of buying mortgage-backed securities are a little nervous. So I go, because the question comes up all the time. Well, why isn't there more yield at the 6.5, 6.75 note rate? Because I really need to refinance this guy and pay for his closing costs. Well, back to spreads and back to if the investor thought that rates were going to stay exactly where they're at today for the next 2 years, they likely would pay more for that up higher. Um, but a little predictor is when you see those types of compression in the rate stacks, that's telling me that the investors are maybe thinking that rates might go lower.
Yeah,
So
telltale sign of compression in the rate stack for anybody that's listening, wondering what the hell we're talking about. If you see a rate sheet and you see that 6 1/8 is paying more than 6.25, that's what we're talking about. And that's because 6 1/8 can slot into a 5.0 MBS coupon, whereas 6.25 has to go to the next one higher. So that's showing an investor preference for that lower MBS coupon because that lower MBS coupon is more insulated from what investors call prepay risk, which is basically just risk that somebody is going to refi to a lower rate and cost that investor their ability to collect that higher interest over time.
yeah, and effectively everything that was originated um, a couple of years ago is if it's not in the money today, it'll be in the money here in a couple months. And so those things are going to get smoked. If I'm an originator today, best advice I can give you today is don't rely on your CRM to call your customer, get them on the phone today, because what's going to happen well, I can assure you what's going to happen. Everybody that didn't fight through this thing is renewing their NMLS license today so they can take some of your refis away from you over the next 6 months.
Not
That's my
only that, and your servicers are going to be hammering in
yes.
cases where you're not the servicer, servicers are going to be hammering these people.
Yeah. So just stay in front of your customer. So, Matt, what would it take, besides, well, I guess it would be mostly jobs, but what would it take to get pricing firmly into the fours?
Yeah, so here's the really exciting thing about that. It wouldn't take any change in the economic data that we have today. If jobs kept coming in the 100 to 200 range in NFP, and if inflation kept doing what it has on average for the past 4 months, exactly that, nothing more, nothing less, that would take rates into the fours. It would just take time.
Yeah. This is the good news part of your session. That there's hope. What I just heard from you, Matt, the light at the end of the tunnel may not be a train. We may have some positive news to report. And it's like the last 2 quarters we've been doing this, Matt. It's just been like, are we sure we want to do this? Because we don't really have anything to tell anybody other than that rates are high, and we don't know when this is going to change. But all good things come to an end, and all bad things come to an end at some point. So
Yeah, that's funny. The last slideshow I put together, I don't think it's one that I did for you guys, but it was where the horse shit slides came from, and it was like I did 8 slides or something convincing people that rates were going to go higher, and then did the horse shit thing, and then I did 8 slides convincing people rates were going to go lower, and the whole point was to say, you can be persuaded one direction or the other. But as I was doing that presentation at some point, I think in early August, maybe late July, I'm like, you know what? These slides that talk about rates going lower, these actually make more sense to me right now. So I'm going to say like this actually, you guys can be a little bit optimistic because I think that we are turning a corner. Maybe I got lucky because I hate predictions, as you know. But yeah, I think we got a chance finally, feels like.
Finally, I mean, and we're seeing some refinancing happening today. I mean, it's like anything that was originated at 8%, rates are in the sixes, so you can save 2% here, which brings to Dale Walker has a phenomenal question, which I'm likely going to screw up massively. But how do you advise discussing with clients whether to refi now or wait for a better opportunity later? Assuming loyal clients who won't be picked off by competition. Let me answer the first part of that. All your customers cheat on you. They will, if unless you stay in front of them. Like even when I was a loan officer, my most loyal customers were the ones that shot me the most. So don't assume anything. Take that out of your, there's no loyal client if somebody's offering a rate that's 2% better than yours.
Yeah.
There's a couple ways to answer that. Like, I'm assuming that if you could refinance them right now, that you would save them some money, right? So that there's some kind of cost savings analysis. Maybe they originated, there's a lot of questions like how long ago did they originate the loan? How long have they had the loan? Any other life experiences you need to pay for? I'm assuming you're not doing cash out, you're just doing rate and term. But what the advice I would give them is if you really want to protect that downside and you really want to drop it down some more, I'm seeing on rate sheets today, paying a point right now during a refinance to make sure you get all the way as far down as you can makes a lot of sense. And oh, by the way, let me tell you the thing that's not going to happen, in my view. If they're waiting for rates to get back down into the 3% range, I don't see that happening.
Not anytime soon.
Like a lot of really, really bad things would have to happen.
Right.
Every other part of the world would be not acceptable to you, but we'd have 3% mortgage rates, right? So you take that off the table. So if you can get somebody into the fives firmly today, and maybe they pay a discount point or two and get them, in the low fives, you'd be hard pressed to get any lower than that, I think, over the next 6 months, right? So you'd have to get firmly into the fours, not much, but a really bad jobs report could send us down there. There's a question in here about election, which all companies, all traders have analysis on whether dude wins or the other one wins. I don't think it affects our mortgage rates at all. What'll happen a year from now is based on their economic policy and tax cuts. Those may affect interest rates, but there is no perfect time to refinance. It would be like a bond trader trying to find a perfect hedge. It doesn't exist. The only time that's good for a customer is when it's good for them. And if you're saving them some money and they can recoup the closing costs within 2 to 3 years, it makes all the sense in the world to refinance now. And I'd highly recommend looking at here's the no cost version. Here's paying a point to buy down that rate to make sure you're covered on the downside risk. So I don't, and please don't ask us if we are encouraging you to lock or float, because we'll never give you that answer. So yeah,
there really isn't a right answer.
No, I mean, because I could tell you to lock today and I'm going to be wrong. If I tell you to float today, I'm going to be wrong. And there's some other data points coming out this week, but rate sheets are looking good. They're looking better than they have in the last 2.5 years. So take that as your small win today, and take advantage of that.
1.5.
Yeah, 1.5. Yes. Okay. Question. And Matt, maybe this is a time you have to pull out your sword of Damocles on here. What is the Fed going to do or not do next week? And if they don't do what we're asking them to do, Matt's got a solution for that. So
so the Fed is definitely going to pull out their axe and they're going to cut rates. So this is my little prop. I just did a little bit of blacksmithing last week. So they're definitely cutting us a foregone conclusion. The only question is whether it's 25 versus 50 bips, or 0.25 versus 0.5%. And to reiterate something from early in the talk, if they do a quarter point, which is highly likely, then they will probably try to sprinkle in a little bit of rate-friendly verbiage, either in the announcement itself or in the press conference, and just remind the market, yeah, we only did 25 today, but we are definitely willing to do more. And they're also going to show people exactly what they're expecting in the dot plot, because this is one of the 4 meetings out of the 8 every year where we get the dot plot that shows the outlook that each Fed member has for where the Fed funds rate is going to be. And that's probably going to drive the market reaction more than the realization of 25 versus 50 bips.
To
So I think
tag
they'll cut 100 bips by year end. I mean, they got 2 more meetings, so that's possible. Definitely possible. That would be one more 25 bip cut and a 50 bip cut. Do I think they will? I don't really want to answer that, but I think it's like every bit as possible as any other scenario, dependent on economic data. So, I mean, if jobs continued to deteriorate in the same way they have in the past really 6-7 months now, definitely 100 bips likely, I would say. But if NFP, non-farm payrolls, bounces back up and over 200K for 3 months, and I maybe only 75 bips.
To answer that too, it really depends on which jobs number you look at, the one they issue or the revised one they do the month after. And so we've had a significant number of revisions to the data over this year. And so now it's almost become comical. You're like, hey, they released the jobs data. Okay, well, I'm going to wait 30 days and see what it actually was. The one key indicator that we're following more than probably the government issue data, you can get a little bit better insight looking at the ADP data, because that's actually probably a little bit more relevant to the time period. And we're seeing a lot more reaction in the bond market to the ADP data now than we are government data. So one big, huge revision downward or bad ADP next month, and 100's definitely on the table. Because what they don't want, what they're really trying hard not to do, and they're not out of the weeds yet, is this hard landing scenario, which would mean unemployment jumping up considerably, companies tightening up their capital base. That would be a bad thing. Question on jumbo securitization, zilch, nada. It's been exceptionally slow, and that part of that is when the agencies raised the loan limits up to like almost over $1 million for everything, and kind of got rid of a lot of loans in the jumbo space. And if you look at real estate across the country, the housing prices that are going down the most are housing prices that are at $1.5 million or more, which would put you in the jumbo market. A lot of that inventory is standing or coming down in price. So hardly any jumbo securitization happening today. On the opposite end of that, you're still seeing quite a bit of non-QM securitization happening. That's become a very popular product, whether it's DSCR or kind of the bank statement programs. And MG answered, it's mostly a retail game.
I also wanted to say, in terms of the jobs revisions, the Bureau of Labor Statistics has a link. If you just type in BLS NFP revisions, the first hit will be all of the revisions going back to like 1971, I think. And you'll see a clear trend emerge where when the labor market is expanding, the revisions tend to be to the upside, sometimes significantly so. And when the labor market is contracting, the revisions tend to be to the downside. So it's not really any surprise that now that we're having the most marked cooling of the labor market that we've had since 2020, we also have the biggest average downward revision since 2020. You'd have to go back to 2008 to see something similar. And that was the last time before that the labor market was cooling as markedly as it is now. The only difference right now is that it's cooling because it's coming off a boil as opposed to tanking, which is what the last 2 times were. But it does work on the other side of the coin, just nobody talks about it. And that was definitely the case in 2021 and 2022. We had huge upward revisions. Nobody really seemed to care at the time, because at that point, it was the government was underselling what it was doing. So who wants to talk about that?
No. Yeah, and if you look at the jobs number, it's really sector specific too. And so it's not that when you see a downward revision, well, like hospitality is probably getting hit harder than any other component of the employment number than anything. A lot of people are still employed, but some of the hospitality sectors are starting to decrease. You can see that kind of what's going on in the Airbnb sector, and hotels and travel has definitely cooled. But again, you can't take one piece of data and apply it towards the whole economy. It just doesn't work that way. I love your answer, Matt. So this is a hard question. your manager would probably know more than this. What's a good recoup, break even, reasonable for paying points? 3 to 5 for sure. Again, you have to ask questions like, how long do you really like this house? Do you plan on staying in it 3 to 5 years? Yes. Okay, then it's probably good to pay the point. If you don't like the house, you plan on moving in 2 years, don't pay the point. It's really back to duration. How long do you plan on staying in that house and why?
And providing options, like you said a second ago, too. What's wrong with showing somebody, here's one way you could do it, here's another way you could do it. What makes more sense to you?
Yeah. Yeah. On the other way of doing things, it's probably a good idea that we talk about one cool thing. I'm looking at the screen right now, and we are not inverted on the 2s and 10s right now by 1 basis point. So other options that could come available if this continues down that path. Two things. An inverted yield curve generally is a recession indicator. We're now no longer inverted. We're almost effectively flat today. Any thoughts on what happens if this continues down this path, and what happens with ARM options?
Oh gosh, no, that's like mysterious arcane magic to me. And sometimes like ARM rates are driven even more so by an individual mega bank's preferences on their balance sheet. So if they're too exposed to fixed rate risk somewhere else, then they're going to look to add floating rate risk, and that won't always necessarily line up with what's going on in the Treasury curve. But yeah, I mean, in general, lower short-term rates help set a lower index for ARM rates at the very least. So that's always going to be helpful. So yeah, I mean, like you said, ARMs can get back to the point where their rates are lower than 30-year fixed here pretty soon.
Yeah, you would probably need to see before an ARM comes into play. If you're really following technicals, that 2 and 10 spread needs to probably be 30 or 50 basis points more than it is today, before you would see any kind of 5 or so 1 ARM that would make sense. So I get asked
Yep.
that question a lot. And by the way, we don't really control that price. That's something that the agencies pass through and say, here's an ARM price for you, right? And we put it into the rate sheet. So it's a great question. And RL, I couldn't agree more. This Bears helmet is likely the best helmet probably in the NFL right now. We had such a phenomenal week. It's been like, I don't know, half my life where we finally might have a good football team this year. But with all the things in play in the current market, no longer in play from previous markets, where do you see rates settling, assuming stable inflation and employment? Define stable inflation first, in employment, Matt.
Yeah, so if inflation was stable at 2% and employment was modest but not recessionary, uh, there is such a huge variable from net treasury issuance. So it's not about what president is in the office, but it's more about, does one political party control both chambers of Congress and the Oval Office? Because in those cases, it's much easier to create net revenue problems, which is part of the rate spike in early 2017 when there was full GOP control and they could deliver the tax cuts. And you could see the same thing if it was full Democratic control and you could spend on programs and increase taxes. So assuming no change in the current pace of Treasury issuance, well, no change to the expected trajectory, I should say, because the pace of issuance is expected to drop. So if it drops as expected, I would think rates would settle in somewhere between 4% and 5% as a safe lower bound. Yeah, I mean, I don't want to get too specific because there are too many other variables apart from inflation and jobs.
Yeah, so 4.126%. No, I'm
Yep,
just kidding.
on the
Yeah.
nose with, yeah.
And it's funny because this inflation number, when you really study it, there's a certain amount of and the notion of permanent inflation. The economy has changed, like since people started tracking inflation, basically from day one. And Matt, you said it earlier, like we're in uncharted territory right now in this new digital economy with AI and efficiency and productivity and stuff offshore and the way goods are traded. it's really, there's some unknowns out there on, and a lot of people work from home and how energy works. Like, I don't really think anybody knows what the perfect inflation number is, as long as it's in some way not exceeding your GDP. It's likely a good number, but like, I don't know what this is supposed to look like. And I don't think any economist has said, hey, look, the number should be 2, or it should be 1.5, or 1, or flat.
Yeah. Yeah. It's just kind of the Fed's best guess that
Mhm.
2% is a pretty good target. There's no hard math to show that that's the case. Well, I'm sure there is some hard math where people have, cited research that says this suggests 2% is good, but no, really, it's more of an idea than a hard and fast rule. And yeah, they want it to be at a point where it's not skyrocketing up and away, and where it's not risking tipping into deflation. And that's really tricky right now because we do have goods deflation that has been ongoing, and it's been just more than offset by service sector inflation, particularly as you noted in housing and insurance and some other places. So it's definitely a delicate dance right now.
I bet you AQ would have a number. He would have a number in the back of his head. It needs to be exactly this, and Symphony AI would tell him us exactly what to be looking for. But, and by the way, AQ wanted to be on, but he is now in manager meetings, so he is. But he sends his regards to the whole community for sure. All right. Any other questions from the queue? I'm looking at both chat rooms, and Oliver Orlicki is holding court over in the chat, and he's not talking about this, so we're fine. Good. So, Matt, I got a question.
Yes, sir.
How can people get signed up for mbslive.net, and what does that mean?
Yeah, it's complicated. You have to go to mbslive.net and you have to click sign up, and it's hard.
It's
You can
super
put in the code the number 4 and the word weeks, and then that will streamline your sign up process, and you won't have to put it in a credit card. But even if you did put in a credit card, it's not like we're trying to hold you hostage. You can quit anytime.
hard.
Only you wouldn't want to. I mean, that would be silly, but
Once you're in, you're kind of in for life. So, well, Matt, I want to thank you for number one joining us today. We had a very full audience. I want to thank you for what you do for the industry and for the community, and for the participants on the phone. Thank you for joining. Again, if you're a loan officer, I need you to call your book today. Super important. If you're a broker owner, get your loan officers to go call their customers today, because those big bad servicers are coming after your book, starting effectively today. If you have any questions, you can join mbslive.net. There's a full chat room. Matt's there to answer questions all day long, or most of the time. And I hope all of you that have made it through to this point finally get to reap some of the rewards from all your hard work over the last 3 years. So I appreciate you all. I hope you have a great day and a phenomenal rest of September. We'll talk to you soon.
thanks.